Hi everyone, and welcome back to another simple daily practice drill I think you can use to become a better trader. And this one is called trend or trading range. For this exercise, what I want you to do is focus on higher highs and higher lows, lower highs and lower lows. And we're going to connect them using trend lines. The purpose is to use a very simple definition to find a bull trend, a bear trend, and a trading range. So let's go. This video is part of a series of deliberate practice drills that you can use to help you improve your identification of trend versus trading range when you trade. Let's take a look at this first drill. This is part of a series on trending versus trading range, and we're going to look at higher highs and higher lows. We're going to start with bar 1. Did we go above it? Yes. Did the low go below? No. Did we go above it? Yes. I'm going to connect these lows just so I can double check. New high, new low, new high. This low is broken. So now I'm going to connect those higher lows. You can put the channel line above it. That's fine. For now, I'm just going to put the bull trend line underneath. Now that this swing point has been broken, the bull trend has ended. And that's the bar that ends it. Now you've got a lower low. For it to be a bear trend, we need a lower high and then a lower low. And the point at which it becomes the bear trend is this bar here, because now we've gone below this low and now we've got a lower high. So at this point, we can now connect this trend line here. New low, go above the bar, get a new low. So we're in a bear trend. As I said before, if you want to connect the channel line, you can do that as well. For a bull channel or a bull trend, the trend line is below. That makes it easy to know when you break through it. The bull trend channel line sits above. When we're looking at a bear trend, the bear trend line sits above the bear trend and the bear trend channel line is below. So now we just work through the process. Okay, so now we've got a lower high. Now we've got a lower high. Now we've broken above this lower high. So where did the bear trend start? Well, really, it started here and it broke there. This might be slightly different to the way you read price action. I think this is an important drill because it is this bar when we are trading, which gives us the new low. At this point, if I'm a bear, it's okay for me to sell because I'm selling in a bear trend. By practicing the individual bar, it's going to make it much easier to apply when we're trading. Just practicing connecting highs and connecting lows on a static chart in hindsight is going to just lead to hesitation when you trade. So that's broken. Now we've got a higher high. We never get a lower high, lower low up till here. Now we've got a lower low. Now I've got a lower high. I've put these two swing points here so that you can practice this concept. Bulls go above one lower high. Now they go above two lower highs. So it is too late to sell now. The bull trend has probably started here. Let's keep going through the process. New high. We went below that bar. That's not great for the bulls. We went above that high. We didn't go below that low. So now we've got a very small bull trend. That's the higher high. That's the higher low, and it breaks. So this bull trend really is only here. Now we've got a new low. Can we get a lower high and a new low? There's a possible lower high. No, we went above. So trading range, new high, new low. So we've got a bull trend here, which then breaks on this bar. We go below a swing point. We're in a trading range. Now we get a break below this bar. Why is the bear trend starting there? Because at this point, I've now got a lower high, lower low, lower high, another lower low, channel line. Now the tendency will be to move the boxes back like this. And that's okay. But for the purposes of this drill, I want your focus on the exact bar that makes it okay to short. I'm not saying you have to sell here at the close one tick below, but it's the signal for bears to start selling. Now we get a new low, lower high. Can we get a new low? No, we don't. We start going up. We go above this bar and we go above a second lower high. I don't mind if you put it to that bar, but that first bar to me puts us in a trading range and we're probably low in that trading range. But once you have that bar, now you're in a bull trend. Buying is more likely. So in that first example, we had a bull breakout above yesterday's high that eventually failed, but it provided a variety of opportunities to get short using this process. Let's take a look at another example with a trading range open with an expanding triangle. New low, new low, new low, pull back, but never got a new low. Now we've gone above. Now we've got a new high. Can we get a higher low and then a higher high? No, we're back in the middle of this range. So we set a low, we set a high, and we sat in this range until here. Now we've got a new high. Now we have a pullback, potentially. Now we've got a new high. It's from this bar. We're in a bull trend. Pullback, inside bar, pause. New high, pullback. We actually go below a swing point here. So now we can put the box. Now we keep going. New high, inside bar, small bull trend, pulls back. Now what you're going to find is that if you focus on the individual bars, you're going to have a trend with lots of small boxes instead of a giant bull trend. For the purposes of this drill, I think that's very useful. Why do I think that's useful? Well, if we're in a trend and we keep going below swing points, then I'm going to trade it like a channel, not a strong breakout. And the best entries here were not breakout entries. The best entries were breakout entries here while the trend is valid. Now that we keep breaking it, it's more likely to be traded like a channel. And we continue the process. Now we get a new high, higher high. Technically, we've got a higher low somewhere in here. New high, possible lower high, and then a new high here. So you see what's happening because we're already in a channel, and then we break it immediately.
So in this second example, we've got an expanding triangle. Traders are trying to work out, is it a higher high, higher low, higher high? Is it bullish or is it bearish? And in that example, we broke to the downside and the upside. But if you waited an additional hour for it to confirm, then the market gave you a variety of very strong long entries for a swing. It also happened to be an opening range breakout trade, which usually sets a further away target, which should give you plenty of time to take that trade.
Where's the lower high? Here. Now we break it. As soon as we get a new low, we're bearish. It gets broken on that bar. Now, how do most people practice this? They go, oh, it's a bull channel, or oh, it's a bull channel. Now, I don't think there's anything wrong with doing that. But if you want to do it this way, the best way is to go up a time frame. If you're going to use the 15-minute chart, well, here's your new high, new low of the day, low of yesterday. So new low, new high, possible new low, not until here. On the 15-minute chart, new highs, pull back, new highs, pull back, new high. Now we can draw a channel line like this. And when does it break? That's the bar that breaks. This is on the 15-minute chart. Now, if I go down to the 5-minute, all of that is a bull trend, which would be the equivalent of doing that. So now you've got your two different ways to practice. On the micro level, on the time frame you're doing, and also one time frame higher. Okay, let's pick another day. That's only got part of a day, so let's do this one here. Bit of a trading range day, 25 August 25. So we start off, we've got a new low. We go above it, and instead of making a new low, we go above it again. Now we go below the bar, and now we've got a new high. So at this point, we've got higher highs and higher lows. At this point, we've got a bull trend. Here's an inside bar. So we were going up, and then we went below it. So we've gone below that swing point. We've got an equal high, and now we've gone below. So now we've got a small bear trend. You can see what's happening in this trading range. It's very confusing. We went above that swing point and we went below. Trading range behavior. Now we've gone above, below. Can we get above that high? Yep. Okay, now we're back to a bull trend. Pull back, new high. So we had a small bull trend in here. The bear trend didn't really work. New high. This is a high and a low. High, low. We go above that bar. So this is the start of the bull trend up until we go below this bar here. So this was the bar that sealed it. Now we've broken it. Now we start the process again. Can we get above that high? Now we've got a new high. Here's a pullback. So bull trend broken. We're in a trading range. We need a new high. We get a new high, pull back, but we need that new high to confirm the bull trend here, and then we break through. Here's a higher low. We've broken through on this bar. Now we've gone back above. So what do you do here? Well, this is a new breakout. Where's the swing point? Here or under the breakout bar? We've gone through both of them on this bar. So we're either in a bear trend or a trading range. We need to pull back. Here's an inside bar. Some traders will measure it from when we go below the inside bar. Other traders will measure it from a new low here because the inside bar is the end of the leg. Eventually, it's the start of the pullback. Now you got a bear trend. New low, inside bar, new low. Did we go above it? New low, inside bar. Do we go above it? No, new low. And there's your bear trend. So in this third example, we've got a trading range open, but it's a gap down and a new low. So having a default as well, we're either in something bearish or a trading range, prevents you from doing anything here. The moment we go above that new high, the bull trend starts, but then we have an inside bar, we immediately go below it, still in a trading range. Now, you can see back here, if you'd waited for a new high of the day, your bull trend would move to there. I've got no problem with you doing that. But by having a micro view of how these bars are working might help you to get in a bar or two earlier. How would you use this for trading? Well, the moment we switch into a bull trend, you should only be looking to buy. The moment we switch into a bear trend, you should only be looking to sell. So this switches into a bull trend, buying and buying lower was okay. Switch to a bear trend, selling higher is okay. Once we get consecutive bull bars over the moving average, buying or buying below was okay. We've switched into a bull trend 3 times. A lot of traders will see that as 3 legs. This bar here puts the market into a trading range or a bear trend, but you can see most of the selling didn't happen until when? Until we went below that inside bar, this low, selling and selling above was okay. So in summary, let's just work through these 3 examples one more time. In the first example, we had a small bull trend that broke, we had a small bear trend that broke, and then a sideways bull trend. This was mostly a trading range day before FOMC, and by putting the boxes where I have, it's going to help me decide to use trading range entries as opposed to trend entries. What does that mean? The moment the bull trend breaks, probably buyers scaling in below, probably sellers selling above until the trend confirms. Once that bear trend confirms here, either that first bear bar or the second bear bar, new low of the day, suddenly selling above bars was way better. This was a new low and a new high. As soon as we broke that, selling above, buying, buy below. That's why there were more traders buying here. The market needed a new low, a new high, and then a new low again. Somewhere between this bar and this bar, we're back into a bull trend. Buying, the pullback was okay. As soon as we started breaking below those swing points, it's either a bear trend or it's a trading range. You notice because this bear trend never confirmed, this is expected. Second example, I wanted to show an expanding triangle trading range with a spike and then a channel. And instead of practicing like everyone else does, like this, which is going to make it way more difficult to trade because you can only see that channel an hour and a half after you're trading. By doing it this way, you can see we confirmed a bull trend and broke it. Okay, we're probably in a trading range. That's the low, maybe that's the high, maybe the high is higher. Either way, I'm in a slope trading range. The bear trend was only this point, and on a day that's this bullish, suddenly deciding to sell down here, it's probably a bad idea. And this day as well, gap down, but a bull trend to start with. There were more opportunities to go sideways, a buy or buy below, and then several hours of selling.
Well, thanks very much for watching. I hope you found that valuable. In this video, we looked at 3 separate examples to practice micro swing points or swing point trading to help us understand the difference between a trending environment and a trading range environment. This is a key fundamental in day trading, and I think you can get a lot of mileage out of this concept. It's also a fantastic way to prepare for the session you're about to trade. My name's Tim Fairweather, and I'll see you in the next video.